here for the party. Trust me, we just
Hey there,
getting
Dale.
started. The sound,
And
the
happy April
vibe.
Fool's Day.
I feel so
I feel like we're making this video on a very bad day. I don't know how many people will take us seriously.
Well, it's meant to be serious, but let's throw some humor in.
Yeah, we might as well. Hopefully, you gotta take us seriously. We're not trying to do anything for April Fools, but we figured the information today is extremely relevant because tomorrow is a big day. It's a day of reckoning for the United States, in the words of the administration. But we'll talk more about that in a bit. Mortgage-backed securities, we're having a rise. This is really counter. Now, it doesn't look like much, but really pay attention to the height at the beginning of the March season, and now we have officially broken into the best market of 2025 for mortgage interest rates. Remember, red and down is bad, green and up is good. It's an inverse of what we expect on mortgage rates. When mortgage rates decline, this chart goes up, and when this chart goes down, mortgage rates go up. That's it. I'm done confusing you. Dale, we were talking about the magnitude of changes. What do you see here?
Well, it's kind of funny. We speak of magnitude, and I think of the Richter scale, and for earthquakes, and that's kind of what we got here. I think it's very, very interesting. If you look at March, all of March, even though there's some up and down squigglies, it's relatively stable. If you look at prior to March, there's some really big swings there. So, metaphorically, let's hope that the major earthquake is over and now it's just small aftershocks.
That's a very apt description, and basically we're looking at the thickness of all these Japanese candlesticks. One other thing I'd like to point out here, this is all still uncertainty. Right now, there are factors, we're going to get into them, on why we're seeing this entry into the new best market for 2025. Do understand, though, we've broken through these lines, these colorful lines. These are moving averages. We've broken above every single one of them, which is kind of spectacular. And we've also, these lines here are Fibonacci levels. I'm not getting into those, but the fact that we just broke over it today, Tuesday, April 1st, is no joke. It's actually a really good sign. So, all right, I'm going to move away from that before we get in more trouble. Dale, what's happening with interest rates?
Well, interestingly enough, they've gone down just a hair, not very much. In fact, if looking at the chart, they look like they've pretty much stayed the same for a little bit, but they are slightly lower than they were the week before. And again, on this chart, down is really good. And we're if you have to go back to August and September to have rates about where we're at now. So we're headed in the right direction, and all the new economic policies, I guess we'll see how we fare.
Yes, and that's going to be the theme. We'll jump into that. One quick thing of note is the 15-year rate mortgage. It actually went up last week on Thursday. Now, we've talked about this before. I'm not going to go in depth, but usually it's a bellwether event when the 15-year either expands the gap or condenses the gap between a 30-year fixed rate mortgage. So this is just a sign of uncertainty, the fact that the distance between the two is starting to shrink. We will see what next week does, because this is a first week trend. So it could just be a minor event, a minor blip, but we'll have more news about this next week. But the big contender, this is what everyone's worried about, is tariffs. We're going to blast through this, and truth be told, there's so much that's not on this list that might be important, but these are the big ones.
Can I point out the very first word after tariffs describes everything?
Yes.
Uncertainty.
Yes. And that's the theme here. That's why we're seeing the 15 and the 30 year condense a little bit, and that's why we don't really know what's going to happen. We're having a great last 3 days in mortgage-backed securities, but that's only 3 days. That's not the long term. So uncertainty in the short term, we just don't know what's going to happen. We know that Trump has been talking about using tariffs as a bargaining chip. We know that he touts them as something that's really awesome and it's the greatest thing since sliced bread. We don't really know what he's thinking, whether you think that's good or bad. It just creates uncertainty. But we do expect there's a rise in inflation in the short term. This has not been a strange thing. Even the Trump administration has said that we expect this to rise inflation in the short term. There's going to be less consumer spending in the short term. When inflation goes up, spending goes down. This might cause a little bit of strain, and it's going to hurt a lot of people. However, we do expect higher domestic GDP in the long term. This is important because it's domestic GDP. US dollars stay within the US, and that circulation helps grow things a little bit better. There are going to be fewer short-term jobs because as inflation rises, companies will have to cut costs, and labor tends to be the biggest one. So we're going to see some job losses. But we do expect with tariffs that we're going to have higher long-term jobs. And the reason being for this is we're going to bring in more manufacturing. Let's talk about that. Short-term manufacturing is probably going to go down because inflation, cost cutting, businesses can't stay open. So that might be an issue. But as we just said, higher long-term manufacturing. We're bringing more companies in. Car manufacturers are bringing in. We're having AI brought in. We're having chips being made in America now. We're going to be starting to do more drilling and oil production, all this other stuff. Then we're going to have the potential for short-term trade wars. Who knows if Canada, Mexico, France, Great Britain, they're going to appreciate these reciprocal tariffs come tomorrow. But at the same time, there is a potential loosening of international tariffs. Maybe these other countries are going to see that charging us 225% for lumber that's coming from the United States isn't necessarily an equal trade between the countries. So all this being said, if anyone's telling you that they know where it's going, they probably don't, and they're just sticking with something political. But, one thing we do know that's happening is the 10-year U.S. Treasury is dropping like a brick.
Yep.
So
Yeah.
why is that important?
Well, there's only so many investment choices, if you will. Yes, there's all kinds of different stocks and bonds and all that good stuff. But with the U.S. Treasuries falling, that indicates a recession. Unfortunately, a recession is bad for people in terms of jobs, but recessions are great for mortgage rates. And I think if you compare the treasuries going down and then you look at mortgage-backed securities going up almost proportionately, let's hope for some good rates, but I think we're headed for some economic challenges having nothing to do with rates, just economic challenges in general in the near future, simply because of everything that's going on.
Yep. And I think that's the best thing to highlight here. We've talked about it before. We're not taking delight in the fact that there's going to be some suffering. Recessions are never good. Inflation is never good. It makes life difficult, the actual real to life. But if we're talking purely in the sense of mortgage interest rates, well, these are all good signs that we're going to see a decline in mortgage rates, and potentially the Federal Reserve will have to make motions and steps to lower the federal funds rate as well, which in kind will also impact mortgage rates. And then the last big thing, you've already touched on it, Dale, jobs. Jobs. I hate to say it, but the more people lose jobs, the closer the Federal Reserve will be to cutting interest rates. So we're seeing a lot of cuts. Oh, sorry. Go for it.
No, I was just saying, which will eventually affect mortgage-backed securities. If you can't invest in treasuries because you need something stable to invest in mortgage-backed securities, which will help rates in general. Unfortunately, as we've discussed, the loss of jobs will hurt a lot of people, and that's very, very unfortunate.
Yep. So we leave you today. No April Fools here, but we appreciate you watching, and keep an eye out because tomorrow we're going to get some jobs numbers, and they will help indicate what direction Treasury goes and what direction mortgage-backed securities go. Dale, as always, thank you so much.
You betcha. Have a great day.
You as well. Bye.
Okay. Bye.